Hey guys, welcome back to another video. Identifying market direction and true reversal points can often be tricky because the market usually makes many false signals before a true trend reversal happens on the chart. So how can we identify a true reversal point based on price action and smart money concepts? In this video, we're going to share with you a powerful trading technique that combines smart money concepts with RSI divergence as confirmation to identify the true market structure shifts on the chart. Here's a count of what we are covering today. First, we'll discuss the features of the RSI indicator. Then, we'll demonstrate the correct usage of RSI divergence. Finally, we'll explain how to use divergence as confirmation to identify reversal points in conjunction with smart money concepts. Starting with the basics. What is the RSI indicator? The Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of price movements. It helps traders identify potential trend reversals and overbought-oversold conditions in the market. To add this indicator to your chart, simply click on the Indicators tab in the TradingView platform. Then type RSI into the search bar. When the Relative Strength Index appears in the search results, click on it, and it will be applied to your chart. When the RSI rises above the 70 line, it typically suggests that the currency may be overbought. This means that the price has increased significantly in a relatively short period, and there is a possibility that a price reversal or correction may occur soon. Conversely, when the price falls below the 30 line on the RSI, it usually indicates that the currency may be oversold. This suggests that the price has decreased significantly in a relatively short period, and there is a possibility of a price reversal or bounce back. Now, this is how traditional traders use this indicator. The problem with this concept is that the price can stay in overbought or oversold conditions for a long time. This happens because there's no fixed limit to how high or low the price can keep going. And if you place trades solely based on entering overbought and oversold conditions, you will likely encounter many losing trades. So how do we use the RSI indicator? One effective way to use the RSI is by identifying the divergence between price and the indicator, which can signal potential trend reversals. So what is divergence? Divergence occurs when the price moves in the opposite direction of an indicator, such as the RSI, suggesting a potential reversal in the current trend. Here on the chart, the price has broken the previous structure to the upside, creating a new high. But if we look at the RSI, we will notice the indicator has made a lower high, which created a divergence. And as you can see, it has resulted in a trend change. This concept is not limited to the bullish scenario, and it can be used on the opposite side as well. Here, the price has created a lower low, but if we look at the RSI, we will notice that it has created a higher low, which is a divergence. Once again, it has resulted in the market structure shifting from a downtrend to an uptrend. Now, what is the psychology behind RSI divergence? RSI and price divergence reflect a disconnect between price action and momentum, indicating potential exhaustion in the current trend, which traders take as a signal for a possible trend reversal. Now, here are some pro tips for making the RSI divergence more effective. Number 1. The RSI divergence works best when it has entered the overbought or the oversold area. It shows that, firstly, the price has increased significantly and rapidly, indicating a potential reversal or correction may occur soon. Secondly, the divergence signals a possible market structure shift. Number 2. Use the divergence concept in the trending markets. In ranging markets, where prices move sideways, RSI divergence signals may be less reliable due to the lack of a clear trend direction, making it challenging to act upon divergence signals effectively. So, make sure that you use this concept when you can clearly identify the trend. Number 3. The divergence occurs after a long-term trend. When a trend lasts a long time before RSI divergence happens, it means more people are involved and the price has moved strongly. This increases the chance of a big reversal, giving better opportunities for traders to profit from the new trend. While RSI divergence is a popular price action signal used by many traders, there are some issues associated with applying it to live trading. For example, consider this chart. In this scenario, the market is in a downtrend, but the RSI signals a divergence, suggesting a potential reversal. This might prompt traders to look for long trades. However, the market subsequently makes another lower low, and upon inspecting the RSI indicator, you'll observe it creates another divergence again. Now this scenario can repeat several times until the price finally decides to reverse and begin its upward movement. Now that's why we combine the RSI divergence with the reversal concepts of smart money trading to confirm our entry. This makes our trading plan stronger, helping us find better times to enter the market with more confirmation and confidence. So let's continue with the next topic, combining the RSI divergence with a change of character. In a bullish scenario, when the price breaks and closes below the lowest point of 2 consecutive highs, we refer to it as a change of character. Similar to divergence, it signifies a loss of momentum, suggesting that buyers are losing control and the price could reverse downward. This support area served as the final barrier before the bearish movement, and the buyers were unable to maintain this level. The main distinction between them is that the change of character occurs within the market structure, providing strong confirmation for the reversal. So forming a change of character after the RSI divergence is a strong reversal signal. Combining the divergence with supply and demand areas. Imagine this chart represents our higher time frame. Let's examine the latest price action. We have a bullish market that consistently forms higher highs and higher lows. Therefore, our overall bias remains bullish. The optimal area to seek a buying opportunity is within this consolidation zone because it offers a favorable risk-to-reward ratio, and placing a stop-loss below this zone can provide a secure placement. If the market manages to pull back to this area, we can zoom into the lower time frame to identify entry signals for long positions. Here in the lower time frame, we want the market to show a sign of reversal for this short-term downtrend, and then open a long position in the direction of the higher time frame. If we apply the RSI indicator to the chart, we can see that we have a bullish divergence as the price made a lower low, but the indicator has made a higher low. So this represents the first sign of a possible reversal. This signal later confirms with a change of character, showing that the buyers have taken control, the short-term downtrend is over, and the price can continue pushing higher in the direction of the higher time frame. The same concept applies to the bearish scenario as well. Here, we have a bearish market. This is considered the latest impulsive move that created a fair value gap area. So if the price makes a pullback and returns to this area, the candles that created the FVG would be an optimal trading zone to look for short entries. So, first, we wait for the price to enter our trading zone, and then zoom into lower time frames to look for reversal confirmations and open short positions. Here, on the lower time frame, if we apply the RSI indicator, we can see that once again we have a divergence. So we wait for the price to confirm this signal by breaking below the latest higher low, and then we can look for short entries. But remember, always do your own backtesting to assess how well your trading setups perform on past data, combining the divergence with premium and discount zones. What if the latest impulsive move doesn't show a clear imbalance? In this situation, using the Fibonacci retracement tool can help us find key levels where the price might bounce back. Below 50% is the discount zone, and above is the premium. When we're bullish about the market, we focus on buying in the discount zone for several reasons. It gives us a fair risk-to-reward ratio, since the first target is the recent high. Putting our stop-loss below this lower high is a safe bet for long trades. Usually, the market clears out early buyers to create enough liquidity for the next moves. However, in strong trends with small pullbacks, finding good chances in the discount zone becomes less likely. So, the main concept of the trading idea, when there's no obvious imbalance in the recent movement, is to wait for the price to reach the discount zone, and then search for reversal signals in the lower time frame. This reversal signal might again be a divergence accompanied by a change of character. The same principle applies to a bearish scenario. When the overall trend is bearish, first, we use the retracement tool and wait for the price to reach the premium zone. Then, we seek confirmations in the lower time frame to enter a short position aligned with the higher time frame. Once again, the confirmation is a combination of RSI divergence and the change of character. combining the divergence with liquidity sweep pattern. In the bullish scenario, the liquidity sweep pattern refers to a single candle that sweeps the liquidity below the previous low. This liquidity sweep can be by wicks or body. But the important point is that the price must return to range immediately after this candle closes. In an uptrend, the bullish liquidity sweep is a sign of upward continuation, and a bearish liquidity sweep signals a possible reversal. The same concept applies to a downtrend. A bearish liquidity sweep signifies a downward continuation, and a bullish liquidity sweep signals a possible reversal. Now let me show you how we combine the liquidity sweep pattern with RSI divergence with a real chart example. Here on the pound-yen 1-hour chart, recent bearish movements are evident. The price has rejected this level twice, resulting in equal lows. Liquidity below a low or a group of lows indicates sell-side liquidity. When the price approaches this level, bullish traders will either go long or protect their previously opened long positions. Conversely, breakout traders will go short if the price breaks through this level. The animated movement aiming to capture this liquidity is referred to as sell-side delivery. Now, we observe a valid liquidity sweep pattern as one candle has closed below this green line, and the price immediately pushed higher back inside the range. This signals a possible reversal, as algorithmic price delivery has engaged liquidity by trapping traders on both sides. Subsequently, smart money would go long to engage buy-side liquidity. Additionally, looking at the RSI indicator, we notice a bullish divergence as the price has formed a lower low, but the indicator has formed a higher low. This serves as another confirmation that the short-term downtrend is ending, and the market may begin to push higher. So guys, that's it for this video.